to our advanced financial accounting presentation. This is the content of our presentation. First, let's see an introduction to the consolidated financial statement. If any company is controlled by another company is known as consolidation of company. Here, control means the power to influence the financial and operating decision. Here, inventing company is known as the parent and the company subject to acquisition is known as subsidiary. When the subsidiary invests in another company directly, it is known as subsidiary of the parent. You can understand what the above mentioned point mean by the following example. From now on, we will focus on question number 1 of the past paper 2021.
Here we can see 2021 question of consolidated statement of financial position. Here are the details of statement of financial position. Non-current assets are property, plant and equipment at cost, accumulated depreciation, investment in Ben Limited. Current assets are inventories, trade receivables, current account with Ben Limited, bill receivables, cash and cash equivalents. Equity and liabilities are stated capital, retained earnings. Non-current liabilities are bank loan. Current liabilities are trade payables, current account with Arun Limited, bills payable, bank overdraft. First of all, we want to add the relevant amount to the statement of financial position. Adjustment 1. First one is Arun Limited acquired 80% of ordinary shares capital of Ben Limited on 1st April 2020. Fair value of the non-controlling interest on the date of acquisition was 20 million. As at the date of acquisition, Ben Limited retained earning was 19 million and the fair value of identifiable net assets of Ben Limited was equal to its book value. Then state capital beginning of the year 45 million and end of the year 45 million. Retained earning beginning of the year 19 million and end of the year 24.9 million. After pre-acquisition, cost of control 80% and non-control interest 20%. Post-acquisition, consolidated retaining earning 80% and non-control interest 20%. Then first let's look at the cost of control or goodwill. According to this amount, we will find the goodwill. There are 60 million investment and fair value of non-controlling investment 20 million. Then total is 80 million. Beginning of the year state capital 45 million and beginning of the year returning earning 19 million. Then total is 64 million. After deducting that, the answer come to goodwill. Then 16 million. Now we are find consolidate retaining earning. Arun's retaining earning is 38.8 million. Post acquisition is get retaining earning account balance and 80% 5.024 million and deduct unrealized profit and impairment goodwill. Then total is 8 million. Then finally consolidated retaining earning is 35.824 million. Non-controlling interest. Cost of control is 20 million. Post-acquisition profit, get the retained earning account balance and its 20%, 1.256 million. Then finally, non-control interest is 21.256 million. Adjustment 6. Impairment test carried out on 31st March 2021 revealed that the goodwill was impaired by 4 million. Goodwill is 16 million and deduct impairment 4 million. Then finally goodwill is 12 million. Then impairment double entry is impairment expenses debit 4 million and goodwill credit 4 million. Consolidate statement of financial position. Under non-current assets, goodwill 12 million and under equity, non-control interest is 21.256 million and consolidated retained earning 35.824 million.
Thank you, Bhavya. Adjustment 2. On 1st of April 2020, Arun Limited sold a motor vehicle which was purchased on 1st of April 2017 at a cost of 5 million rupees to Ben Limited for 6 million rupees. Both companies depreciate their motor vehicle over 5 years on the straight line basis at cost. The cost of the motor vehicle is 5 million divided by 5. Then comes the annual depreciation 1 million. It has been 3 years from 1st of April 2020 to 1st of April 2017. Therefore, multiply the annual depreciation. Then comes 3 million. Cost is 5 million. Accumulated depreciation 3 million. Carrying value 2 million. A motor vehicle worth 2 million rupees is sold for 6 million rupees, and there is a profit of 4 million. And then 4 million rupees should be removed by books. Then 5 million rupees motor vehicle is sold for 6 million rupees, and there is a profit of 1 million rupees. That 1 million rupees is distributed among the possible time without removing it from the income statement. That's why 5 million rupees is divided by 5 and multiplied by 4. From there, 0. million. If its double entry is consolidated returning earning debit 4 million, property plant and equipment credit 4 million. Also 0.8 million excess depreciation should be removed from the books. If its double entry is accumulated depreciation debit 0.8 million, returning earning credit 0.8 million. My part is over. Now I invite Teshani to continue the presentation.
Thank you, Hettiarachi. Adjustment 3. The difference of current account balance due to cash in transit. 18 million in Ben's current account and 16 million in Avna's current account. The difference between the two accounts is the 2 million. It's taken as cash in transit. Accordingly, double entry of cash in transit. Cash in transit account debit 2 million and Ben's current account credit 2 million. It that 2 million consolidated financial position statement cash in transit is recorded as 2 million in current asset. My part is over. Now I invite Mansara to continue the presentation.
Thank you, Teshani. Assessment 4. Ben Limited sales good to Arun Limited at a profit margin 25% on cost. Invoice value of 7 million amounted good has been sold during the year and 30% of it remain as unsold at the end of the year as a part of its closing stock. According to this adjustment, the stock was sold at a profit of 25%. 30% of the 7 million goods unsold can be identified. 7 million after calculating percentage of 30%, the value obtained is 2.1 million, which is the value of unsold goods. Now let's calculate the amount of profit related to the unsold item. In 2.1 million, the value of unsold goods is 420,000. This adjustment is recorded in the double entry as follows. Retained earning debit 420,000. Inventory credit 420,000. Now I invite Nitni.
Thank you, Mahinsala. Adjustment 5. Out of the bills of exchange accepted by Ben Limited, bills 4 million rupees have been issued by Arun Limited, out of which Arun Limited discount 2 million rupees worth of bills from the bank. Arun Company has its bills of exchange worth 4 million rupees, a discount of 2 million rupees. To remove the discount, 2 million rupees is deducted from bills receivable under current assets in the consolidated statement of financial position. 2 million rupees will be deducted from bills payable under current liabilities in the consolidated statement of financial position. Double entry is bills payable debit 2 million, bill receivable credit 2 million. My part is over.
Now I invite Samindi to finalize consolidated statement of financial position.
Final consolidated financial statement. The final result is it is balanced to 228.930 million. Our group members are SRX Sasarani, AB Vijayatunga, PGDM Hettiarachchi, JTP Mika, RPP Mahinsala, IHMN Umayangi.